Welcome, Avatar. It's a good time to update everyone on two topics. First off, basic personal finance decisions, and secondly, how to remain educated in the evolving world and economy. The future is certainly different now that the government has printed trillions of dollars. For some perspective, since 2010, which is only 12 years ago, the amount of physical dollars in circulation is up 66%. Looking at the Federal Reserve website, as you can see, the currency in circulation has gone from 29.5 billion notes in 2010 to 50.3 billion in 2020. Also, if you use other metrics like the M2 and M3, it is possible to suggest that around 90% of dollars have been printed since around the year 2000. Since we don't like cutting data and try to keep it simple, you can easily see that over half of the dollars created has occurred since 2008 to 2009 using the M3 metric. Part 1. Saving and Investing Flow Chart. Before jumping into the flow chart, remember, the goal is to create multiple streams of income. Your focus should not be on cutting costs, but on somehow generating more money. Even if it's a time for money exchange for a few months or years, that is fine. The chances that you can make $40 to $50 per hour clipping coupons is practically nothing. As a warning, this section starts at the low end and assumes that you have nothing. In other words, that you're completely broke. Number 1. Think ahead. If you have no money, you have to plan ahead. This means you can look into the following. 1. Credit card reward churning. 2. Gift card discount purchasing. 3. Bank account opening churning. And 4. Quick resells of holiday goods, such as Xbox or PlayStation consoles and other popular products. These 4 things alone are not going to make you rich. What they will do is add a few thousand US for you per year. A simple example is stacking the rewards. 1. Get one that requires $1,500 in spending. 2. Use it to buy discounted gift cards online for places you need anyway, food and clothes, etc. 3. Use that to purchase a popular holiday good for reselling. You can easily create $1,000 worth of rewards plus 10% return on a resell. By the time you start your secondary income source, this stuff doesn't matter. Number 2. Reduce overhead on day 1. On day 1, with nothing, you want to keep the overhead as low as possible. You're going to work 60 to 80 hours a week anyway. So this means reducing rent expense to as low as humanly possible. Don't buy anything high-end in terms of clothing. No one will care if you're broke and 20 years old anyways. Even as you begin to scale up and get richer, we try to keep rent or mortgage expenses to a minimum. As a guideline, well below 20% of after-tax income should be spent on your rent or mortgage. This is the exact opposite of what you're told to do. Number 3. Gather 3 to 6 months living expense. We're using a rough range here as it depends on your financial situation. Living expenses equals your monthly rent payment plus food plus utilities plus healthcare cost. If you have a job or career, and have accrued some vacation days that will pay out, you can be at the lower end. If you will have $0 coming in, assuming you have been fired or laid off, then you shouldn't be at the low end. There is really no situation where you want to have less than 3 to 6 months in emergency money. Anything can happen. You could have a sudden medical expense, the company you work for could go under or be acquired, so on and so forth. If you're aggressive about your expenses, you should be able to get to this level in 3 to 6 months. You should be able to save around 50% of your take-home pay, because you're not going to focus on going out or flexing for your first 2 to 3 years anyway. Oh, and by the way, any girl you're dating who cares if you live with roommates at age 20 to 23 or so, is not someone you want to deal with long-term. Dating life is not a good excuse to spend money living alone in your early 20s. Number 4. All company matches. This one should be obvious, but you should take the company match. There is practically no exceptions. This has nothing to do with crypto or stocks or bonds. It has to do with math. If you get a company match that is a 100% return on day 1, there is no way to beat that. The math behind it is pretty straightforward. If you contribute $5,000 pre-tax, and by the S&P 500, the company will match you and also buy $5,000 worth of the S&P 500. Now some will argue that you have to pay penalties and taxes if you remove it early from your 401k. That doesn't matter though. If you were to pull the money out, it would get you $10,000 multiplied with 1 minus tax rate minus the 10% early withdrawal penalty. Even if you had a 40% tax rate and a 10% penalty, that is 50%. This means you get $5,000 worth, which is post-tax. Again, there is no logical reason to avoid the company match. You could take the money in and basically get part of your earnings post-tax instead of pre-tax. Number 5. Move into crypto. At this point, this would be the third investment idea. If you already have 3 to 6 months of living expenses and are maxing out your company match at the firm, you should have no problem buying some large-cap crypto. Don't buy any high-risk small caps, most are Ponzi's, so you have to be smart and correctly get into them early to lock in any sort of return. As a note, this third level assumes the following. 1. You're already working on a secondary form of income. And 2. You do not have any upcoming liabilities to take care of. If your goal is to have one form of income and suddenly become a trader or investor to get rich, it's not going to work. Only 1 in 1 million will succeed with some high-risk gambling strategy. Unfortunately, a lot of people have learned the wrong habits due to all the craziness that occurred in 2020. The good news is that these people will lose their money over the long term and creators and producers will win as they always do. Just look at the richest people in the world, all of them are producers or creators. Number 6. Calculated risk. At this point, you should have various directions. You should be flooded with options. Unlike jugglers people who work on 10 to 15 projects at the same time, you have 2 to 3 income streams and know that there are options for you. 1. Go with product A. 2. Sell the company and go with idea B. Or 3. Continue to scale current income streams and invest into crypto, stocks, or buying your first residence. There is no way that we can make this decision for you. The one thing we would say is that you probably need to add around $50,000 to your savings account. This is because a new product or business idea usually costs $50,000. If you have 2 to 3 successful income streams, you don't want to be forced to sell them. Instead, by saving intelligently, you can start the other idea immediately. Number 7. Real estate. Pretty big change. Before, we had real estate as a wealth creation vehicle, but that has changed. You're free to do whatever you like. In our opinion, you're better off just having one place to live and no other real estate exposure. The problem is as follows. 1. Internet sites sell for lower PE ratios and are easier to fix. And 2. Taxing a home and rental income is a lot easier. The tax setup has changed to a point where you can live in Puerto Rico or Singapore and get much better tax treatment when compared to real estate. Where else can you get 0 to 7% tax rates? The second issue with rental properties is the inability to move. If you start buying in a particular area, you need to be there to manage, otherwise you lose even more returns to a property management firm. Real estate compared to internet sites just isn't comparable anymore. Unless you have expertise in the area, we'd stick with internet sites and other forms of mobile passive income. The final item is clarity on the ownership structure and adjustments. If tax changes come in, you can do a ton of different things with internet-based businesses. For example, you can sell part of it and maintain minority ownership, have various LLCs to spread out the ownership, you can move to a better location, you can adjust the business model, so on and so forth. Your options are better since the income is not tied to a physical location. Number 8. Financially independent. Once all of your passive income is generating more than your living expenses, you're free. There isn't much advice to give at this point. You simply don't touch the passive income savings. This prevents you from taking too much risk and allows you to do whatever you like with all of your future earnings. No one is going to get to financial independence and suddenly quit the business. It doesn't work like that. What does happen? After you grind it out for a few more years, you begin to prioritize things differently. For people with kids, it usually shifts in that direction. For people who make tons of money, there are two paths. 1. Become ultra-competitive and want to be number one in the space. And 2. Become more lifestyle-focused and interested in something fun and less stressful that does pay the bills. That's it. Here is the flow chart. You can pause the video if you want to take a closer look. Ask yourself which step you are on, and what you can do in order to get to the next step. We have now come to the end of this video. This is the first part of a two-part series. In the next video we will talk about college and education, and how it is a scam. If you like this video, then you'll love the next one, so make sure to subscribe so you don't miss out on it. And in other news, banks are zeros.